Okay, so with that, I'll just kick off my presentation. And of course, first of all, thank you everyone for joining me here today for this webinar. I think if we look towards, over the past years, I think things have been sort of very unprecedented. I mean, my presentation today is focused more on the indices, whereas Manish later will focus more on the FX. But if you look over the past 1 month, I think traders continue to face a lot of indecision regarding anchoring down, exactly how high the Fed rate may have to go. When will the interest rate actually peak in terms of the US, which could carry some global implications across the world. And just to provide some context, I think if you look at the Fed funds futures movement, which shows sort of market pricing for the interest rate outlook, in just a very short span of over the past 1 month, I think we have gone from pricing for the Fed's peak rate to be at 4.9% in January. If you look at it now, we are currently pricing for peak rate at 5.5%. So that is a very hawkish increase. And we have also gone from pricing for 53 basis point of rate cuts, just 1 month ago. But currently, if you look at the, the data, it suggests that, markets are not pricing for any rate cuts through 2023. And all of this recalibration is just happening in 1 month, considering that the Fed is data dependent. With that, markets are also data dependent and adjusting their interest rate expectations, as and when we have this new data coming in. So I think the overall recalibration of, where rates will be, whether economic conditions can hold up, those will remain the key market theme. And looking towards the upcoming March, I think that is where things get much more interesting. I think it will determine whether we will get to see another very strong job report next week, next Friday in particular, or another month of upside surprise in inflation. And of course, we have the March FOMC meeting, and where there are already bets in place that we will see the Fed revert back to a 50 basis point hike. So will that be true? So very, very interesting month up ahead. Okay, so just some disclaimer as a start. Do take note that this presentation is for educational purposes only. It's purely my personal view. It does not in any way constitute any investment advice. So please do your own due diligence in your trading journey per se. Okay, so just 2 things to take note here. I will not, delve deep into where I come from, but just 2 things. One is my Twitter account. If you have a Twitter account, do drop me a follow at ip_IG. And if not, we also have an IG Telegram group, which is called IG Asia. So you can join for free, and every day you will be able to access some real-time and also updated market content from our team of analysts globally. Okay, so now let's take a look at how the US indices have performed so far, just over the past 1 year. I mean, if you look at the chart on the right, it suggests that, value is still the preferred choice ever since the COVID-19 recovery. But if you look towards the start of 2023, based on the chart on the left, there's something very interesting whereby it seems to show that growth is taking over some form of a leadership in terms of indices movement. If you look at the Nasdaq chart as depicted by the gray line, or if you look towards the October to December period last year, it's kind of met with a period of indecision. We have this consolidation pattern before we see some renewed upside coming in January this year. So while on the contrary, if you look at the Dow Jones, which is depicted by the orange line, it seems to show somewhat a different picture. So we have a period of a bullish move back in September, all the way till December. Thereafter, it then falls into a ranging pattern to start 2023, all the way until now. So in short, there seems to be somewhat of a passing of a leadership, a baton to the more sensitive, more rate sensitive growth counters to drive indices movement ahead. So of course, we probably have to see some participation coming back from the value counters to sort of reinforce this broad-based move in the indices. But I'll be sharing some technicals levels to watch later. But for now, it seems that there could be some chances that the heavy lifting has been coming from growth, particularly the mega cap counters. And in terms of sector performance, I think if you look at the 1 month and also of course the year-to-date basis, rate-sensitive sectors have generally outperformed. Largely on the year-to-date, you can see that it's the consumer discretionary, technology, and communication services. And just to take note, this comes at a time where we see the US 10-year yields jumping very strongly, more than 30 basis points for the month. And in the past, when we talk about higher yields, expectation of additional Fed rate hike, that would have undercut equities and of course other risk assets as well. But recently, I think even though we are seeing somewhat of a strong sell-off with this hawkish recalibration in terms of the market rate expectations, definitely what we are still looking out for is whether we can form any higher low ahead. So over the past few months, we have seen this attempt to recover. So we have formed this series of a higher low, which suggests that probably some of the market bulls are attempting to take control. So whether this time round, this sell-off, it will still form a higher low, that is still possible. And that's why we have to look out at certain key levels that I'll show later. But generally, I think there is still some hope that the markets can continue to sort of hold up. But of course, certain levels will be on close watch. And I think recently, previously, we have been talking about this narrative of a hard landing. So over the past quarter, you see these headlines popping out a lot of whether we will have this hard landing narrative. But switching to 2023, first quarter, it seems that markets have been swapping this hard landing narrative to sort of one that says a no landing. So this is kind of a new term being coined, basically in that, inflation are high, but economic conditions are also sort of holding up. So I mean, in a way to provide some further context, if you look at the US Treasury yields, the 2-year yield is actually back to retest its November 2022 high. Whereas if you look at the 10-year, it's also back to its December 2022 high. So all these movement in US Treasury yields are sort of back towards their multi-high. But if you look at the indices, it seems to show that major US indices are still sort of nowhere near its November or December low. So in a way, my view is that this resilience seems to relate to the idea that whether equity markets can continue to withstand these higher rates if strong economic growth has been driving all of these yields movement more greatly than a hawkish Fed playing catch up to sort of this runaway inflation. So very interesting landscape right there over in the US. And if you look towards the European indices, definitely they have delivered some outstanding performance over the past few months. Recently, some near-term retracement, but generally they have all performed very well since October 2022. And some of them have even moved on to deliver near record highs. So you look at the FTSE 100, it has been sort of least impacted by the war in Ukraine, whereas Germany DAX sort of have been the hardest hit, largely due to its energy dependence, but generally more encouraging resilience in these economies, especially in the face of all of these headwinds. On the technical side of things, sort of some positive momentum, but I think recently there was this bearish divergence that caused this slight pullback. And if you look at the Asian indices, more of a flattish to a slight drift lower over the past 1 year. I think the very key notable one will be the Hang Seng Index. So recently we have seen the very strong sell-off and sort of nearing back to its 200-day moving average. And today we are seeing the stronger than expected PMI figures out of China. So I think being able to defend this 200-day moving average, that could retain its overall upward bias trend. So later I'll just I will just show all of you the chart. But for now, I think Hang Seng Index will be one to watch this year. It used to be the worst performing index, but with the reopening bets coming back into play, I think that has helped to drive some form of a catch up, especially towards the end of the year, to be more aligned with the rest of the region. So after going through the whole a broad picture of where global indices are currently at, I think the main, in terms of the macro picture, if you were to recall previously, Fed Chair Jerome Powell actually mentioned at the last FOMC meeting that he actually mentioned this exact word, that the disinflationary process has begun. And with that, it kind of sparked a bullish reaction in markets. But thereafter, we have this upside surprise in inflation coming back in to challenge, the Fed stance that are we really getting this inflationary process when inflation readings are coming in higher than expected, which means that rates have to remain high for longer. I think overall, if you look on a quarter basis, I think the disinflationary process is still in a way largely in place. I think we could need to see more data of upside surprise in inflation to really establish a trend. I mean, because one data may not necessarily sort of provide the overall longer term picture. And if we look towards expectation for the next upcoming CPI, I mean, that could potentially bring back the disinflation theme, because expectation is for pricing pressure to moderate as well. So definitely a very key reading to take note. But as of now, I think the broader trend is still suggesting that pricing pressure may continue to moderate over the coming months. And on another note, if you look at the US break-even inflation rate, in a way, it has largely remained well anchored as well. So it has fallen from its previous peak back in March 2022. It has revised down by quite a fair margin, and is currently at sort of consolidation, hovering around the 2.5% range. So I mean, yes, the recent upside surprise in inflation reading has sort of caused these jitters, has sort of revived these hawkish bets in the markets. That whether rates have to move higher. So we are seeing this hawkish recalibration taking place. That is the catalyst for jitters. But I think in a way, if you compare to a year ago, probably we are in a much better place at current point in time. Likely because 1 year ago, the Fed is still largely can catch up. So we are seeing very strong interest rate increase, 75 basis point, 50 basis point. But zooming to current time, I think progressing with 25 basis point move is still largely the consensus. So rate hike is kind of more measured, even though it will continue to push into restrictive territory. But the scale, the extent of the hikes itself is more measured, sort of more limited as compared to a year ago. And economic conditions have been sort of holding up better. I think we may still have an economic downturn, but generally, if all this stronger than expected economic data coming in, it may suggest that timeline could be pushed back. That's just my personal view. I think it could be pushed back, and within that time frame, it kind of provides some leeway for the risk environment to recover. So with that, I think generally we got to see more inflation data, but moving forward, there's still in my view, some hope that the overall trend could be towards further disinflation. Okay, if we look towards market breadth, generally when we look at market breadth, it kind of suggests the stocks participation in the market rally. So overall, I think more and more counters across different sectors are participating in the recent rebound. I mean, recently there surely has been a sort of a pullback, but it still had sort of in a higher level as compared to many months ago. So I think as you can see, the heavy lifting is brought on by the Nasdaq recently. And if you look towards some of the more risk sensitive asset class, such as your crypto and also your small cap. So I think if you just look at the crypto market, it seems to be more resilient lately. I mean, still falling within this consolidation ranging pattern, but recently it's hovering near the upper resistance. So there wasn't very huge sell-off that we are seeing there. If you look at the small cap, as compared to the broader market, the S&P 500, generally the small cap are still sort of outperforming. So there's still some appetite in terms of these riskier assets. largely because, it shows that in a way, I think the risk environment has sort of improved from many months ago. And if you look at the percentage of new 52 weeks high, recently the small cap Russell 2000, it kind of saw a spike from a previous low level. So some form of a renewed traction towards the smaller cap counters. And I think, this could be sort of a pricing for these economic conditions to hold up at least in the near term. Okay, and based on several other measures, I think in a way the risk environment have improved from a year ago. I think the chart on the left kind of denotes, is a chart that denotes high yield corporate bond versus a US Treasury bond. So generally, when you see the ratio increasing, it may suggest that credit spread are narrowing. So what this means is that there are some optimism among investors regarding the health of companies and also the economy as a whole. So in a way, we are seeing this formation of higher low thus far. So that seems to point towards some easing economic worries for now. And overall, I think if you look at this chart, the ascending triangle pattern is in place. I think greater conviction may come if it can actually push to a new 6-month high. And on another note, I think there are some market pricing that, with much of the front loading rate hikes being done, whereas economic data still showing some form of resilience. In a way, conditions may start to hold up. And on the right is the chart of the year-on-year change in the US manufacturing PMI versus the S&P 500. So generally, the manufacturing sectors comprises of approximately 30% of the broader US economy. But in terms of the stock market, there's a stark difference in that the manufacturing sector actually holds close to 50% of the S&P 500 market capitalization. And having moderate, very sharply over the past 1 year, I think the S&P 500 on a year-on-year basis is starting to show some form of a turn, seemingly positioned that, economic conditions may continue to hold up thus far, and that stream of economic data coming in has sort of been well received as well. Okay, and talking about sentiments, I think in a way there has still been this switch from previous extreme bearish sentiments to recently a slight push into the bullish territory based on investors' positioning. And in terms of the other way, whether we have a severe economic downturn or not, I think it surely remains on the table. But data thus far, sort of suggests that in a way, there are still some hopes that could provide a runway for recovery. And if you look at the CBOE put-call ratio, generally there has been this unwinding from a previous bearish mood in the options market. So generally, both indicators are not at those extreme overbought levels yet. So that kind of provides some runway for the risk environment to recover further. But definitely, as I mentioned, some of the key levels that I'll show you later, I think those will definitely have to see some form of holding up ahead. Okay, I think currently with all those jitters in risk assets, it's basically the product of markets recalibrating their rate expectation. So in the near term, definitely some volatility expected while we continue to trend in this adjustment phase, trying to align our market expectations with the Fed policymakers' view. But in a way, compared to past few months, I think market expectations have been slightly more aligned with the Fed's view now. So previously, if you were to recall just a few months back, markets are still saying that we may not need to move rates above 5%. Whereas the Fed policymakers are saying that, yes, we have to move above around 5.1%. So, but recently, over the past 1 month, there has been sort of this realignment. So now our markets are believing that, yes, we need to move rates above 5%. We may not get a rate cut in 2023. And that is what, the Fed policymakers has previously been pushing for, that, there will not be any rate cut in 2023. And previously, markets were still expecting a rate cut, but now, it's more aligned, definitely. So I think in a way, that could be looked upon that, if you were to see this alignment between market expectations and also the Fed's view, I think it suggests that there could be room for more positive surprise. So in a way, current markets are pricing for 3 more 25 basis point hikes over the next 3 meetings. So in a way, if you were to see this pause and wait stand from the Fed policymakers, that could turn out to be sort of a less hawkish surprise. So I think with this alignment, it caused near-term jitters, but if we were to see sort of ultimately sort of equilibrium in that sense, it could provide some room for markets to recover as well. Okay, in terms of corporate earnings, I actually took these from Refinitiv projections. If you look at the recent earnings results, I think based on this projection, we are supposed to see the worst conditions in corporate earnings playing out the previous quarter or the upcoming, this first quarter 2023. And we look towards most of the others, most of the sectors, I think largely a turning point is expected to be in place at the upcoming first quarter results. So of course, longer term wise, generally I think there could still be the risk of further moderation in economic conditions. But at least now, there are some runway for the risk environment to recover, sort of providing that, this worst is overview, that economic conditions are holding up. And I think that could sort of, provide some form of a runway as well for to draw in buyers for a push higher. So if you look across the sectors, I think some of the more notable ones are generally tech. Those are seeing some form of worst is over stance over the past quarter. And I think the more notable one, if you just look at the energy sector, I think previously the energy sector has been the top performing sectors in 2022 based on the war-induced higher oil prices. But moving forward, whether they can continue to sustain this stellar earnings growth that they have witnessed over the past, past 1 year, the projections suggest that we could see some form of a moderation ahead through 2023. If you look at the energy sector, in a way, my chart shows that it's kind of reaching a moment of reckoning that could be lying ahead. So just based on this energy select sector fund, I think in my view, we are looking at a double top formation. Recently, sort of nearing the neckline coinciding with the sector's 200-day moving average. So I believe that, if you were to see a breach lower of this key support, that could pave the way, based on this projection of double top pattern, could pave the way to retest its September bottom. So definitely one to look out for over the coming days. Okay, now for the technical, for the indices, in a way, what we are looking out for is this formation, whether the indices can maintain the formation of a higher low. So overall, we see some support, a series of support lines being present. Some have given way for sure, like the 4,000 key psychological 4,000 level, marking with this Fibonacci confluence. So that has sort of failed to hold up. But over the on the downside, we are also seeing the 200-day moving average trying to keep this upward trend going. So I think if you were to see a breach below this 200-day moving average, that could create more widespread implication. I think those trend following funds and also quants they could actually sort of see some unwinding if the 200-day moving average is sort of being breached. So definitely one to watch. I think for now things are still trying, the buyers are still trying to defend this 200-day moving average line. So definitely one that we will want to watch to see hold up. In the event that it's breached, I think that could sort of move back to retest the 3,800 level based on this chart itself. And for the Dow Jones, I think we have been seeing this ranging pattern over the past few months, just bouncing between these two ranges, kind of supported by this flat line MACD, which shows that momentum is just moderating. So some broader indecision in the indices, and that actually brought the Dow Jones towards its lower consolidation range. And likewise, I think is also nearing a key support, 200-day moving average as well. And if we were to see a breach lower, that could unlock further downside to the 32,000 level. But we will want to see these support lines hold up over the coming days. Yeah, and that will definitely be one to watch. Okay, likewise for the Nasdaq 100, so we are seeing that all the US indices are actually back to retest many of those key support lines. And the Nasdaq 100 is also back towards its 200-day moving average. And this level is actually where we saw the post-Fed strong bullish reaction after the Fed meeting. So we have some deep buying activities there previously, and now it's actually back to retest this level itself. So definitely want to watch. We know that today there is this the China's PMI figure trying to lift the overall mood in the risk environment. And over the past, just yesterday, I think the VIX has also seen some form of unwinding. So in a way, we will really want to see some risk appetite coming in to really defend some of those key levels. And previously, when we talk about major indices, if you look towards the seasonality pattern, you'll hear all of these words that says that February tends to be a weak month, but now we are aging towards March. So generally, seasonality-wise, March tends to see some form of a recovery towards April. So in a way, whether that will be true, definitely we'll want to see this formation of these higher lows to keep this upward trend for these major indices intact. Okay, now we talk about some of the positives. I think there are probably two risks that we will definitely have to keep watch on the radar. I mean, one will be the turnaround in inflation, whereby we see inflation making a U-turn, and that kind of throw the disinflation narrative off the table and kind of challenge whatever the Fed has done so far. So that will definitely be one risk that we'll be watching. And the other is that we see the hard landing narrative coming back. So if you look at the 6 months leading index, it has actually seen a very huge reversion. So meaning that there's a potential that economic conditions will continue to moderate sharply ahead. If you look towards some of the recession, more well-known recession indicator, I mean the 3-month to the 10-year treasury spread, the PMI readings below 47. I mean those are generally looked upon as a sort of a precursor to a recessionary pressure ahead, and those have started to play out, in December, in November last year. So it suggests that that we could still see a hard landing, but economic data so far has been turning in a more resilient than expected. We could argue that policy tightening tends to come with a lag in terms of its impact on the economic conditions. So our business cycle economic conditions could continue to hold up a little while more over the coming months before it starts to moderate. That remains a possibility on the table for sure. But for now, it suggests that there's a chance that our conditions are still resilient to sort of drive some recovery in the risk environment, and we have to see really a very sharp turn in economic activities to really instill this hard landing narrative back, and that could cause the next wave of a sell-off. So far, I think looking at the strong labor market, services activities are also holding up very strongly. I think there is a chance that for now we are still pushing back against these fears of having a hard landing, and whether markets can ride on this narrative to sort of recover some grounds coming after the strong bearish sentiments of the past 1 year, that will definitely be watched and could be a possibility that's placed on the table. Okay, unemployment rate, just now I mentioned that the US labor market is still very resilient. Generally, I think the labor market will be the last shoe to drop, just based on the previous historical downturns. Generally, if we see a strong surge in the unemployment rate, that could create a huge recessionary force. But for now, I think that hasn't played out yet. So in a way that unemployment rate is still at its multi-year low and job openings are actually picking higher. So there's still a very strong labor demand in the US. So in a way, back to the story of economic conditions are still showing some form of resilience. Okay, S&P 500 valuation, I think more towards fair value, and depending on which metrics you see, I would not say that they are cheap at a current point in time, just more of sort of a fair value play at the moment. And on the other side of the globe, I think China continues to ramp up its support for these countries' economic recovery. I think we are seeing the second consecutive month of outperformance in terms of the PMI recovery. And its accommodative stance have also been showing up in recent months. I think if you look at the net injection from the PBOC, they have been injecting a huge amount of net cash into its financial system. So in a way, this suggests that supporting growth continues to be China's top priority by keeping liquidity ample. And I think there are still a few catalysts in place for Chinese equities to outperform this year. I think the first phase will be the recovery in the economic conditions, whereas moving on, we'll be looking towards the growth and the recovery in corporate earnings. And in a way, we could still be expecting to see a more aggressive easing move coming back into the picture through 2023. I think that cannot be ruled out for sure. I think China's property sector is still struggling. And of course, exports have also sort of weakened. While the strength of the rebound in consumption is strong for sure, but whether it can hold up is still uncertain. But at least on the policy front, I think the general stand is that policies will remain supportive over the coming months until we are seeing that recovery is on a sustainable trend moving forward. Okay, and I think if we look towards the region, comparing the Asian indices, I think we cannot forget about the US dollar. Generally, they tends to have some of an inverse relationship. So in a way, for the Asian indices to recover, we need to see US dollar index sort of trend lower to provide one of the tailwinds. Recently, we are seeing a strong recovery in the US dollar, but moving forward, whether it can form a lower high as a sort of a downward, overall longer term downward bias, I think that remains on the table. And if you were to see that, that could actually be a positive for the Asian region to recover. Okay, and for Hang Seng, I think after the sharp rebound towards the end of last year, it's actually back to its fair value now, sort of hovering around its 10-year historical mean, just based on these two metrics, the forward PE and also the price to book. So I would not say it's so much of a value play now. I think we are moving towards the next phase of a more growth focus. So we need to see a recovery in economic conditions and also to drive some of the corporate earnings revision moving forward. If you look at the Hang Seng, I think recently it inches back towards its 200-day moving average. And today we are seeing a strong sort of a rebound. And I think that generally the overall upward trend still remain intact as long as this line holds. We should really sort of mark this confluence of support with one of the feeble level as well. So I think there are chances that we could move higher to retest the early 2023 high, moving over the coming months. Okay, next up for a more local context for Singapore, where is the STI heading towards? I like to look at the fund flow data that is released by the SGX every week. And for now, it seems that over the past 2 weeks, there have been strong net outflows from institutional investors that still, far outweigh the inflows that we've seen over the previous month. So you can see the past 2 weeks, it kind of marked with a very strong downward spike below, which means that, there's net institutional outflows. Last week, there's around 286 million. Whereas it is the retail investors that have been jumping in, buying at a massive amount. So how I look at this is that, there could be the potential for some distribution at play. So it's still a question of whether we can see further upside for the STI index. And in terms of the sector breakdown, I think we have seen record earnings coming from the banks based on the net interest income portion, but the financial sector has not been seeing much of an inflow from institutions. So looking over the past few months, I think there has been this pairing of exposure that has been in place. Since the end of last year, after a strong slight build up net long, but now it seems that we are in this distribution phase for the financial sectors. And other notable observation, I think the steady inflow in consumer cyclicals, largely tapping on the borders reopening, pent-up consumer demand. And on the other hand, if you look at the REITs, which is the dark blue line, the REITs continue to see some lack of attraction. So with consistent net outflows over the past 2 years. So the question here is, the overlying key overhang here for REITs is that, markets are struggling to digest, where the overall interest rate environment will peak at. And that comes as a trade-off for REITs, which tends to be riding on this dividend paying kind of status. But in terms of REITs wise, my stance is that it could be more attractive on a longer term play. If you look at the price to book ratio, the valuation is below its 10-year historical average. And but near term wise, if you look at the chart on the left, it is really the spread with the government bond yields. Because if you have the risk-free rate turning in at an attractive rate, that really puts into question of the yield spread with the REITs, whether are you worth it to take on the additional risk in REIT counters as compared to many of those risk-free government bonds. So that is the overlying pressure that have been weighing on the REIT sector. But once we have a greater clarity for that, I think generally the Singapore REITs tends to be more resilient in terms of their asset pricing and also in terms of their economic outlook. So we see that over the past 1 year, many of those REITs are still increasing their dividends at a time where their share price are dropping. And some of those have many very strong track records of being able to deliver consistent dividends even during times of economic distress. So I think still attractive, but definitely more of a longer term play. In the near term, we'll continue to struggle with seeing the yield trade-off, especially with government bond yields on the renewed upside recently. And for the STI valuation wise, probably slightly underpriced. So probably not too much of I think in a way, if you look at the STI, it can be underpriced for many years. But generally, I think valuation could be somewhat hard to provide any actionables. But overall, I think sort of still valuation has been trending lower. And in terms of technicals, I think after breaking above a previous consolidation zone, I think the index is actually moving back. Previously, there was a breakout. It failed to cross the 3,400 level, and now it's actually back towards the previous ranging pattern. So generally, I think I'm a bit more cautious on the index, largely because if you were to zoom out over to the longer term chart, namely the monthly chart, you can see that on the monthly time frame, ever since the 08-09 global financial crisis, the index has been trading in this ranging pattern. It has, failed to break out in many times. So I think it seems, based on current pricing, it seems to be nearing the upper resistance once more. Whether we can actually see a breakout to a new multi-year high, that remains on the table, but I think the scenario is less likely. I mean, considering that economic conditions are still uncertain, and I think based on this longer term time frame, there is a very strong presence of a resistance that is lying ahead, especially at the 3,500 level. So my general take is that still cautious. I think the downside risk could be more significant as compared to the upside at current point in time. Okay, so with that, I've gone through much of the global indices. the US, China, Singapore. With that, thank you for giving me the opportunity to share my views with you. If you have any questions, do drop it into the question box.